Welcome back to The Deep Dive, your shortcut to being well-informed. Today, we're tackling a topic that touches many of us, borrowing money for investments. It sounds straightforward, right? You take a loan, buy something, deduct the interest. Simple. But the world of investment interest expense has some, well, fascinating twists and turns. They can significantly impact your financial picture, often in ways you wouldn't expect.
Indeed. Many individuals borrow to pursue investment opportunities, and understanding how the interest on those loans is treated for tax purposes is absolutely critical. We're going to walk through the essential rules straight from the IRS today to ensure you walk away with some really clear insights.
Exactly. Think of this as your guide, not just what investment interest is, but the critical, often surprising rules around when and how you can deduct it. Our mission today is to uncover some major aha moments. Things that could really change how you approach your investment loans. Okay, let's unpack this. At its core, investment interest is the interest you pay on money you've borrowed to acquire property held for investment. Simple enough, but here's where it gets interesting. What exactly qualifies as property held for investment? It's broader than just your typical stocks and bonds, isn't it?
That's right. Yeah, for the IRS, property held for investment goes beyond just, say, a brokerage account. It specifically includes property that generates interest, dividends, annuities, or royalties, as long as these aren't from your ordinary trade or business. That's a key distinction. It also covers property that produces gains or losses when you sell it, again, outside of a normal business context. And here's a surprising twist many overlook. Even if you're a silent partner in a business, not materially participating.
Meaning you're not involved day to day?
Exactly. You're not actively involved in its operations. The interest on money you borrowed to fund that can still qualify as investment interest. But the crucial insight is recognizing when not to count it. Specifically, if it's categorized as a passive activity, like a rental property you just own. That has its own distinct set of rules.
So it really expands the definition beyond what many might assume, okay? But what's equally important for you, our listener, is knowing what doesn't count as investment interest. What are the big exclusions people need to be aware of?
Right. Importantly, this doesn't include qualified home mortgage interest. That's a completely separate category, different rules apply. Nor does it include any interest that's already factored into income or loss from a passive activity. Those rules are separate too. Additionally, you cannot deduct interest incurred to produce tax-exempt income. Think certain municipal bonds, for example. And finally, if you're involved in straddles, which are, well, basically advanced trading strategies involving options or futures to hedge risk.
Right, the complex stuff.
Yeah, the interest expenses on those are specifically excluded and follow different rules again. These distinctions are vital because, different tax rules apply to each type of interest, and misclassifying them can have significant tax implications.
Okay, so far we've defined what investment interest is. But what happens when life gets messy? Which, let's be honest, it often does. Let's say you take out a single loan, but those funds go partly into a new stock position and partly into something personal, like that new sofa you've been eyeing, or maybe paying off some credit card debt. The IRS isn't going to let you deduct all that interest, are they? How do we untangle this kind of mixed-purpose debt?
This is where allocation comes in. And it's a critical concept. Lots of people overlook this. If you borrow money for business, personal, or investment purposes, you must allocate the debt among those specific uses. The significant point here is that only the interest expense on the portion of the debt used for investment purposes is treated as an investment expense. And what's fascinating, and often misunderstood, is that the allocation is not affected by the property securing the debt.
Oh, wait, really? So it doesn't matter if I secured the loan with my stock portfolio or my house?
Nope. It's about how the proceeds are used, not what you put up as collateral. That's a very common misconception.
Wow. Okay, so it's all about the use of the funds. That's a big takeaway right there. So to be clear then, if you borrow, say, $10,000 and you explicitly use $8,000 for buying stock and the other $2,000 for home items, then 80% of the interest on that loan is investment interest and 20% is just personal interest, which you can't deduct.
Precisely. The direct use is key. But it gets even more nuanced. If you receive debt proceeds in cash, they're generally not treated as investment property right away. The IRS essentially treats cash in hand as personal until it's actually applied to a specific purpose. However, if you deposit the proceeds into an account, any account, that deposit is treated as investment property from that point forward, even if the account doesn't earn interest.
Okay, so putting it in the bank makes it investment temporarily.
Temporarily, yes. But here's the catch. If you later withdraw those funds for another purpose, like groceries or whatever, you must reallocate the debt from that point on. The initial allocation isn't permanent if the use of the funds changes down the line.
So it's definitely not a set it and forget it situation then. Okay, so let's trace that. What if I deposit those loan proceeds into my bank account first? Say I borrow $10,000, immediately buy $8,000 in stock, and put the remaining $2,000 into my savings account. Does that $2,000 automatically count as investment money just sitting there?
Yes, for as long as that $2,000 sits in the account, the interest on that portion of the loan is considered investment interest.
Okay.
But the moment you spend that $2,000 on household items or, anything personal, the allocation shifts. From that point forward, the interest on that $2,000 portion is personal. So you really have to track the fund's actual use over time. It's a huge aha moment for many who might think just depositing it locks in the investment status.
Huh. So much for my mental accounting system then. It sounds like the IRS really wants us to be meticulous with these mixed-purpose loans. Are there any rules to help simplify this tracking? It sounds like it could get complicated fast.
Well, there is one helpful rule. It's called the 30-day rule. If you make a payment from any account or even from cash within 30 days before or 30 days after receiving loan proceeds, you can treat that payment as coming directly from those proceeds up to the amount of the proceeds you received. It offers some flexibility in tracing.
Okay, that helps a bit. And what about repaying the loan?
Right. When you repay a debt that was used for multiple purposes, you have to reallocate the remaining balance. The rule is you first reduce the amount allocated to personal purposes, then you allocate the rest of the payment. This generally works in your favor, ensuring the non-deductible personal portion is paid down first.
It really emphasizes that managing mixed-purpose debt requires ongoing attention, not just a one-time calculation at the start. What about investing in pass-through entities like partnerships or S corporations? How does this allocation apply if you're borrowing to buy an interest in one of those?
Good question. If you use borrowed funds to buy an interest in one of these entities, the interest has to be allocated based on the entity's underlying assets. So you kind of have to look through the entity, see what it's investing in. If you contribute capital to such an entity, rather than buying an existing interest, you can use any reasonable allocation method. The key, as always, is that the allocation needs to be logical and justifiable based on the actual use of the funds within that entity.
Okay, moving on. Beyond what qualifies and how it's allocated, the question of when you can actually deduct this interest is crucial. Does it matter if you use the cash method or an accrual method of accounting? Most individuals are cash method, right? But this can still be confusing.
Absolutely, it matters a lot. If you're a cash method taxpayer, which most individuals are, you must actually pay the interest expense before you can deduct it. The money has to leave your pocket, essentially. An accrual method taxpayer, however, they can deduct interest as it accrues as the liability builds up, regardless of when it's actually paid, as long as the liability is fixed.
So paying with a new loan doesn't count for cash method.
Generally, no. If you borrow money, say, and the interest comes due, and you pay that interest with a new note, a new loan from the same lender, a cash method taxpayer usually can't deduct that interest yet. Because it wasn't actually paid with cash or funds from another account. You've essentially just rolled the interest into new debt.
That distinction is really important. A new note isn't payment for cash method, folks. Okay. What about interest paid in advance? Or interest on margin accounts? Those are pretty common for investors.
Right. If you pay interest in advance for a period that extends beyond the current tax year, say, you pay a year's worth of interest in December, you generally have to spread that deduction out. You allocate it over the tax years to which it actually belongs. You can only deduct the portion applicable to the current year. For margin accounts, it's simpler for cash method taxpayers. You can deduct the interest in the year it's paid. And payment here means when you actually remit funds to the broker, or when funds become available to the broker through your account.
Like dividends collected or proceeds from selling stock?
Exactly. When the broker has access to funds in your account, they can use to cover that interest charge. That's when it's considered paid.
Got it. And you mentioned some specific limits earlier. For certain types of investments, like market discount bonds or short-term obligations, this sounds like another layer.
That's correct. Yeah, for certain investments like market discount bonds or short-term obligations, the IRS has special rules. Essentially, your interest deduction might be capped. It's designed to prevent you from deducting the interest expense before you've recognized the related income from that investment, like the actual interest payments or something called original issue discount, OID, which is a form of imputed interest.
So it's about matching the expense with the income.
Pretty much.
Yeah.
Aligning the timing. The good news is any interest you couldn't deduct because of these specific limits isn't lost forever. It can often be deducted in the year you dispose of the bond or obligation, or alternatively, you can sometimes elect to deduct it in an earlier year, but only up to the amount of your net interest income from that specific bond for that year. So there's some flexibility, but rules apply.
Okay, now let's talk about the big picture limit, the one that truly caps your total deduction for investment interest each year. It's tied directly to something called net investment income. This raises a really important question for anyone with significant investment interest expenses. How much investment interest can I actually deduct?
Right. Generally, your deduction for investment interest expense is limited, dollar for dollar, to your net investment income for the year. This is a crucial cap. But like those other limits, any amount you can't deduct because of this net investment income limit isn't lost. You get to carry it over to the next tax year. It's treated as interest paid or accrued in that following year. It just waits patiently for future investment income to offset. So even if it exceeds your taxable income in the year it was paid, you don't lose it.
That carryover feature is incredibly helpful. It ensures you don't permanently lose the deduction just because of bad timing or a down year for income. So what exactly goes into calculating this net investment income? It sounds like a key formula we need to understand.
It is. You figure your net investment income by taking your investment income and subtracting your investment expenses. But remember, excluding the investment interest expense itself. Your investment income generally includes gross income from property held for investment, so things like interest, ordinary dividends, annuities, royalties. However, it specifically excludes Alaska Permanent Fund dividends. That's a specific call-out. And here's the big one. It also generally excludes qualified dividends or net capital gains, unless you actively choose to include them.
The choice. That sounds like a really big decision point. Why would someone choose to include qualified dividends or net capital gains? Aren't those usually taxed at lower capital gains rates? It seems counterintuitive to voluntarily subject them to potentially higher ordinary income rates just to boost investment income.
It does seem counterintuitive at first glance, but this is a critical strategic point taxpayers need to consider carefully. By choosing to include all or part of your qualified dividends or net capital gain in your investment income calculation, you effectively increase your deduction limit for investment interest, meaning you might be able to deduct more of your investment interest expense right now.
Okay, so you get a bigger interest deduction now.
Right. But here's the trade-off. You must reduce the amount of those dividends or gains that would otherwise be eligible for the lower capital gains tax rates by the exact same amount you included in investment income. So the advice from the IRS is very clear on this. You absolutely must run the numbers. Compare your total tax liability both ways with the election and without it. You make this election right on Form 4952. It's all about optimizing your total tax bill for the year, not just maximizing this one deduction in isolation.
That's a powerful trade-off to consider. It really requires a calculation, maybe even running your tax return both ways. What about parents reporting a child's investment income on their own return? Using that Form 8814, how does that factor into the parent's investment interest deduction limit?
Right. If you choose to report your child's interest and dividend income on your own return using Form 8814, a portion of that income can be included in your investment income for purposes of calculating your limit. However, specific exclusions still apply there too. For example, any of your child's Alaska Permanent Fund dividends that got included on your return do not count towards your investment income limit. The key takeaway is that it's not just a straight pass-through of the child's income. You'll need to make adjustments based on the IRS guidelines, which can be a bit detailed, to get the correct calculation for your own limit.
Okay, we've talked about investment income, the top line of that net investment income calculation. What about the other side? Investment expenses. What specifically qualifies there?
Investment expenses are your allowed deductions, other than the investment interest expense itself, that are directly connected with producing that investment income. This could include things like depreciation or depletion, if the asset generating the income is subject to that, like, say, depreciation on an asset that generates royalties, which you're counting as investment income. However, it's important to note, expenses that are used in computing passive activity income or loss are not included here. Keep those separate. And also, for tax years 2018 through 2025, miscellaneous itemized deductions subject to the 2% floor were suspended, so things like investment advice fees wouldn't typically be deductible as investment expenses during this period anyway.
Okay, let's try to put it all together with a practical example. Make it concrete. Imagine Ted. He's a partner in a business, but he doesn't materially participate. So his interest in the partnership counts as a passive activity for him. Now, Ted has $10,000 in other investment income, like interest and non-qualified dividends. He also has $3,200 in investment expenses, say safe deposit box fees or something directly related. And he paid $8,000 in investment interest expense during the year. He also got $2,000 in income distributed from that passive partnership activity. How does his investment interest deduction play out under these rules?
Okay, good example. First, that $2,000 from the passive activity. It's not used in determining his net investment income limit. Passive income has its own rules, so we set that aside for this calculation.
Right, keep passive separate.
Exactly. So his total investment income is the $10,000. Next, we subtract his investment expenses, again, not including the interest, which were $3,200. So $10,000 minus $3,200 gives him a net investment income of $6,800. Now, he actually paid $8,000 in investment interest expense, but his deduction for the year is limited to his net investment income. So his investment interest deduction for the year is capped at $6,800.
Even though he paid $8,000.
Even though he paid $8,000. The remaining $8,000 paid minus $6,800 deducted isn't lost, remember. That $1,200 would then be carried over to the next tax year, waiting for future investment income to offset it. This really shows how that limit directly impacts your immediate deduction.
Okay, this definitely sounds like a lot to track and calculate correctly, which brings us to the actual IRS form that helps with all this. Form 4952. What exactly is Form 4952 and who needs to file it?
All right, Form 4952. Its title is Investment Interest Expense Deduction. It's precisely the form individuals, estates, and trusts use to figure out their deductible investment interest and any amount to carry forward to future years. Your deduction, as we've hammered home, is always limited to your net investment income, and this form is basically the IRS worksheet designed to apply all these rules we've been discussing.
But there's an exception, right? I think I saw that. Not everyone actually has to file Form 4952, which could save some people a bit of hassle.
Correct. And this is another significant aha moment for many taxpayers. You don't have to complete Form 4952 or attach it to your return if all three of these conditions apply to you. 1. Your investment income from interest and ordinary dividends after subtracting any qualified dividends not included in investment income is more than your total investment interest expense. 2. You don't have any other deductible investment expenses, like those depreciation examples, or state taxes on investment income. And 3. You have no carryover of disallowed investment interest expense from the prior year, so nothing carried in from last year.
So if your situation is simple enough, just interest income exceeding interest expense, no other complexities, you skip the form.
Exactly. If you meet all those tests, you can just deduct all your investment interest directly on Schedule A, Form 1040, without needing to file Form 4952. It simplifies things considerably for those folks.
That's really great news for some. Okay, but for those who do need to file it, can you quickly walk us through the main parts of Form 4952, just so they know what to expect when they look at it?
Certainly. Yeah, Form 4952 is pretty logically organized into three main parts. Part 1 is where you gather your total investment interest expense. This includes what you paid or accrued during the current year, plus any carryovers you had disallowed from the prior year. So it's the total potential interest deduction. Part 2 is where you calculate your net investment income, which is the heart of the limitation. This is where you'll input your gross investment income, any net gain from investment property sales, and importantly, make that election we discussed about including qualified dividends or net capital gains. Then you subtract your investment expenses, other than interest. Finally, Part 3 determines your actual investment interest expense deduction for the year. It's simply the smaller of your total investment interest from Part 1 or your calculated net investment income from Part 2.
Smaller of the two numbers.
Smaller of the two. Any excess interest, the amount from Part 1 that's more than the amount in Part 2 is the amount disallowed for this year. That disallowed amount is then carried forward to the next year's Form 4952, ready to be potentially used then.
And once you figure out that final deductible amount in Part 3, where does it ultimately go on your main tax return, like the Form 1040 for an individual?
For individuals, the deductible amount calculated on Form 4952 typically goes on Schedule A, Form 1040, itemized deductions, usually on the line designated for investment interest. However, there's a small wrinkle. If any part of that deductible interest is tied to royalties, that specific portion goes on Schedule E, Form 1040, supplemental income and loss, instead of Schedule A. It's also worth noting, as a final point, that deductible investment interest can impact your alternative minimum tax calculations, the AMT. So it's a detail worth being aware of if the AMT might apply to you. Correctly placing the deduction on the appropriate schedule is important for accurate tax reporting overall.
Okay, so wrapping this all up, What does this mean for you, the listener? We've really dug into what investment interest is, the very detailed rules for allocating it, especially with mixed purpose debt, the important timing considerations based on your accounting method, cash versus accrual, and that overarching limit based on your net investment income. We also highlighted those crucial choices you might have regarding qualified dividends and net capital gains, and how Form 4952 helps tie it all together, or even how you might avoid filing it all together if your situation fits.
Exactly. And understanding these rules, it's really more than just about filling out a form correctly, isn't it? It's about making informed financial decisions. It helps you grasp the true after-tax cost of leveraging your investments. Knowing these limits and allocation rules can genuinely guide how you structure future borrowings, maybe even influence which assets you borrow against or how you manage your cash flow. If we connect this to the bigger picture, knowing these rules can make a significant difference in your long-term wealth-building strategy, especially if you regularly use debt as part of your investment plan.
Absolutely. This deep dive should empower you to look at your investment borrowing with a much sharper eye now. So here's a final thought for you to mull over. How might a deeper understanding of these investment interest rules change your approach? Your strategy for using borrowed money to grow your portfolio? How can you structure things maybe to maximize your deductions over time while, of course, minimizing your overall tax liability?
Yeah, consider how different investment strategies or different debt management techniques like maybe prioritizing which debts to repay first if you have multiple loans, or perhaps timing when you realize capital gains could lead to really different tax outcomes under these very specific rules. It truly highlights the value, I think, of looking at your investments and your associated debt holistically together rather than viewing them as completely isolated transactions.
Powerful stuff. Really important connections to make there. We hope this deep dive has given you a clearer path, or at least illuminated the path, for navigating the complexities of investment interest. Until next time, keep digging for those insights.